48 hours until the largest silver-producing nation on Earth slams the door shut. 48 hours until a supply line that has fed the global economy for 3 decades is severed with the stroke of a bureaucrat's pen. 48 hours until the physical silver market enters a phase of shortage so severe that the word shortage doesn't even begin to describe it. Ladies and gentlemen, welcome to FinSphere Global, and I need you to pay very close attention to what I'm about to tell you. Because by the time you wake up on February 1st, the silver market will have fundamentally changed forever. China is banning silver exports, not restricting, not taxing, not adding paperwork. Banning. As in, 0 ounces of refined silver will legally leave Chinese territory starting Saturday morning Beijing time. The Western financial media is barely covering this. Bloomberg buried it in paragraph 15 of an article about base metals. The Wall Street Journal is too busy writing about AI stocks to notice that the physical foundation of the global electronics industry is about to be ripped away. But you're here. You're paying attention. And that puts you ahead of 99% of investors who will wake up on Saturday morning, see silver up 15%, and have no idea what happened. I'm going to tell you what happened. And I'm going to tell you exactly how catastrophic this is going to be for anyone who does not own physical silver before that clock strikes midnight in Beijing. The countdown has begun. Let's get into it. Let me give you the official details first, because the devil is in the details, and these details are diabolical. On January 15th, 2025, China's Ministry of Commerce quietly updated its export control list. The document is publicly available on the Ofcom website, though you'll need to read Mandarin to understand it. I've had it translated by 3 independent sources to ensure accuracy. Article 7, Section 3, subsection B now reads, and I'm quoting directly, refined silver, silver powder, silver compounds, and silver-containing alloys exceeding 10% purity are hereby designated as strategic materials subject to total export prohibition, effective February 1st, 2025. Violations will be prosecuted under national security statutes. Total export prohibition. Not a quota, not a license system, a ban. Let me translate what this means in practical terms. China produced 5,400 metric tons of refined silver last year. That's 173 million ounces. That's 21% of global mine production. China exported approximately 1,200 metric tons of that silver to the rest of the world. That's 38.5 million ounces flowing out of China into the global supply chain every single year. As of February 1st, that flow goes to 0. 0 ounces. Not a trickle. Not a reduced stream. A complete and total shutoff of 38.5 million ounces of annual supply. Now you might say, okay, 38.5 million ounces sounds like a lot, but the global market is big. Can't we just source from somewhere else? No, you cannot. And here's why. The global silver market is already in a structural deficit. Last year, demand exceeded supply by 215 million ounces. The Silver Institute, an industry body that has historically been conservative in its estimates, called it the most significant deficit on record. We were already short 215 million ounces. Now remove another 38.5 million from the supply side, the deficit doesn't grow to 253 million. It explodes to something far worse. Because that 38.5 million wasn't just any silver, it was the marginal supply. It was the silver that filled the gaps. It was the buffer stock that kept the wheels turning when demand spiked unexpectedly. When a solar panel manufacturer in Germany needs emergency supply, they call China. When a semiconductor fab in Taiwan is running low, they call China. When the COMEX is bleeding inventory and needs to restock, they call China. Starting February 1st, when they call China, nobody answers. Let's address the obvious question. Why? Why is China voluntarily giving up export revenue? Why would they weaponize their silver production? The answer is threefold, and once you understand it, you'll realize this isn't an impulsive decision. This has been planned for years. Reason 1, domestic consumption is exploding. China has committed to installing 1,200 gigawatts of solar capacity by 2030. That's more than double their current capacity. Every gigawatt of solar requires approximately 30 tons of silver. Do the math. 600 additional gigawatts times 30 tons equals 18,000 tons of silver. China's entire annual production is 5,400 tons. Their solar ambitions alone require more than 3 years of total production. And that's just solar. China is also the world's largest manufacturer of electronics, EVs, and medical devices. All of these industries require silver. The Chinese government has done the calculation that every Western analyst refuses to do. They've realized that exporting silver is exporting their own future. Why sell silver to America so America can build solar panels to compete with Chinese solar panels? Why sell silver to Europe so Europe can manufacture EVs to compete with BYD and NIO? The export ban is industrial protectionism dressed as resource nationalism. China is keeping the silver for themselves because they need it more than they need the dollars. Reason 2, the dollar is dying. China holds approximately $770 billion in U.S. Treasury bonds. Every day, the Federal Reserve prints more dollars. Every day, inflation erodes the purchasing power of those holdings. Every day, China watches their savings evaporate. For years, China has been diversifying out of dollars and into hard assets. Gold purchases by the People's Bank of China have hit record levels. But gold is expensive, silver is cheap, and silver has industrial utility that gold doesn't. By banning silver exports, China is effectively hoarding a strategic asset that will appreciate in dollar terms as the dollar depreciates. They're not selling silver for $76 today when they expect it to be worth $200 in 2 years. This is currency warfare. China is betting against the dollar by betting on silver, and they're ensuring that bet pays off by restricting supply to the rest of the world. Reason 3, geopolitical leverage. Look at what's happening in Taiwan. Look at the semiconductor tensions. Look at the trade war that never really ended despite what the headlines said. The United States has been trying to build a domestic semiconductor industry through the CHIPS Act. Intel, TSMC Arizona, Samsung Texas, billions of dollars in subsidies to reduce dependence on Asian chip manufacturing. But every semiconductor requires silver, silver paste for the contacts, silver in the solder, silver in the thermal management systems. You cannot make a chip without silver. By banning silver exports, China has just put a chokehold on America's semiconductor ambitions. They're saying, you want to compete with us in chips? Good luck doing it without the metal. This is the same playbook China used with rare earths in 2010 when they restricted exports during a dispute with Japan. Prices spiked 1,000%. Industries panicked. And China demonstrated that they could weaponize their mineral dominance at will. Silver is the new rare earth. And February 1st is the new 2010. Let's walk through exactly what happens to the global supply chain starting Saturday. Day 1. The panic calls begin. Every major silver consumer in the Western world has a procurement team. Those procurement teams have Chinese suppliers on speed dial. On Saturday morning, those suppliers will inform them that all contracts are suspended indefinitely pending government review. The procurement managers will think it's a mistake. They'll escalate. They'll call their contacts at the trading houses. They'll call their contacts in Hong Kong. They'll discover that this is not a mistake. This is policy. By Saturday afternoon, every major silver consumer will be calling the same 5 or 6 alternative suppliers. The London bullion banks, the Swiss refiners, the Japanese traders. Those suppliers will be overwhelmed with demand they cannot possibly fulfill. Week 1, the premiums explode. When demand exceeds supply, price adjusts. But in the silver market, price adjustment happens first in the physical premium, not the spot price. The spot price is set by paper traders on COMEX who don't actually need metal. The physical premium is set by industrial buyers who need metal today or their production line stops. I expect physical premiums to double within the first week. If you're paying $5 over spot today, you'll be paying $10 over spot by February 7th. If you can find metal at all, for industrial buyers, the premium is even worse. They buy in large quantities. They need certified purity. They need reliable delivery. They will pay $15 or $20 over spot just to secure supply. And they'll do it quietly because they don't want their competitors to know how desperate they are. A solar panel manufacturer cannot operate without silver paste. An electronics company cannot operate without silver contacts. When the silver runs out, the factory stops. We will see announcements from major manufacturers that they are temporarily reducing production due to supply chain constraints. They won't say silver shortage because that would cause their stock price to crash. They'll use euphemisms, they'll blame logistics issues or quality control reviews. But we'll know. We'll know because we're watching the silver inventories. We'll know because we're tracking the premiums. We'll know because we understand what February 1st really means. By March, the production cuts will become impossible to hide. The earnings reports will show the damage. The stock prices will reflect reality. And suddenly, everyone will be talking about silver. But by then, it will be too late to buy. The dealers will be sold out. The COMEX will be drained. The price will have already moved. The window is closing. 48 hours. Now let's talk about what this does to the paper market. Because the COMEX is about to experience a stress test it cannot pass. The COMEX silver futures market operates on a fractional reserve basis. There are approximately 450 million ounces of open interest, meaning 450 million ounces worth of contracts that promise future delivery. Against that, there are only 31 million ounces of registered silver actually available for delivery. That's a 14:1 ratio of paper to metal. The system works only because most contract holders never actually demand delivery. They roll their contracts forward or settle for cash. But what happens when a supply shock makes physical metal unobtainable? What happens when industrial consumers realize they cannot source silver from China and must get it somewhere, anywhere, including the COMEX vaults? They start demanding delivery. We saw this begin in December with the record 12,707 delivery notices. That was before the China ban was announced. That was just baseline industrial anxiety about tightening supply. After February 1st, that anxiety becomes outright panic. The industrial longs will look at their futures contracts and say, I don't want cash settlement. Cash can't run my factory. I need the metal. If even 20% of open interest stands for delivery, that's 90 million ounces demanded against 31 million available. The COMEX has 3 choices, all of them catastrophic. Choice 1, default. Admit that they cannot deliver the metal. Declare force majeure. Settle contracts in cash at a price that doesn't reflect reality. Destroy the credibility of the exchange forever. Choice 2, raid. Use every mechanism available to source metal from the ETFs, from private vaults, from anywhere. Pay any premium. Bribe, beg, or steal the metal needed to fulfill the contracts. This temporarily saves the exchange but drains every other source of physical silver, making the shortage even worse. Choice 3, suspend. Halt trading in silver futures indefinitely. Claim technical issues or market instability. Pray that somehow the situation resolves before they have to reopen. None of these choices are good. All of them result in a disconnection between the paper price and the physical price. All of them result in chaos. The China export ban is the catalyst that breaks the COMEX. It's the straw that breaks the fractional reserve camel's back. And it happens in 48 hours. Let's expand the frame, because this isn't just about silver. This is about the global economy. This is about geopolitics. This is about the end of an era. For 50 years, the Western economic model has depended on cheap resources flowing from the developing world to the developed world. Cheap oil from the Middle East, cheap labor from Asia, cheap metals from South America and Africa. That model is ending, and China is leading the charge. The silver export ban is not an isolated action. It's part of a comprehensive strategy. Look at what else China has done in the past 3 years. They've restricted exports of gallium, critical for semiconductors. They've restricted exports of germanium, critical for fiber optics. They've restricted exports of graphite, critical for EV batteries. They've banned exports of rare earth processing technology. Each of these actions was met with Western outrage and Western impotence. The United States complained. The EU filed protests. Nothing changed. China has learned that resource nationalism works. They've learned that the West has no alternative suppliers. They've learned that they can weaponize their mining and refining dominance with minimal consequences. Silver is the biggest weapon yet. It's not a niche metal like gallium. It's not a processing technology that can eventually be replicated. It's a fundamental industrial input that cannot be substituted and cannot be quickly sourced elsewhere. The top silver-producing countries outside China are Mexico, Peru, Poland, and Australia. Combined, they produce about 400 million ounces per year. That sounds like a lot until you realize that global demand is 1.2 billion ounces and growing. There's no cavalry coming. There is no alternative supply. When China closes the door, it stays closed. And here's the geopolitical dimension that nobody is discussing. This export ban gives China enormous leverage in any future negotiation. Taiwan, trade policy, technology transfer, currency agreements. Whatever the United States wants to discuss, China now has a trump card. You want us to lift the silver ban? Perhaps we can discuss your tariffs on Chinese EVs. You want access to our silver? Perhaps you can reconsider your position on semiconductor export controls. You want your factories to keep running? Perhaps you should be more accommodating on Taiwan. This is resource diplomacy. This is how empires have operated for millennia. Control the essential resources and you control the conversation. The United States has oil, Russia has gas, the Middle East has both, and now China has silver. The balance of power is shifting. February 1st is the date it becomes undeniable. Let's get specific about price, because I know that's what you're really asking. How high does silver go when China closes the door? I'm going to give you 3 scenarios based on different assumptions about market behavior. Scenario 1, controlled adjustment. In this scenario, the market recognizes the supply shock but responds rationally. Industrial buyers secure alternative supplies at higher prices. The COMEX manages deliveries without a crisis. Premiums rise but don't explode. Under this scenario, silver reaches $100 per ounce by April. That's a 32% gain from current levels. This is the optimistic scenario from the perspective of market stability. Scenario 2, disorderly repricing. In this scenario, the alternative supplies prove insufficient. Industrial panic sets in. COMEX inventories drain faster than expected. Physical premiums disconnect from spot prices. Under this scenario, the spot price reaches 125 by March, as the futures market tries to catch up to physical reality. Physical silver with immediate delivery commands $150 or more. This is what happened with palladium in 2022 when Russia invaded Ukraine. Scenario 3, systemic break. In this scenario, the COMEX fails to deliver. Force majeure is declared. the paper market loses credibility entirely. The countdown has begun. In just 48 hours, China will enact a total ban on all silver exports. This is not a drill. This isn't a rumor. This is a published policy decision set to take effect on February 1st, and it will permanently alter the silver market as we know it. Let's break down the numbers. The global silver market is already facing a massive 215 million ounce deficit. China's export ban will instantly remove another 38.5 million ounces of annual supply from that equation. This is the definition of a supply shock. Industrial users, who need silver for everything from solar panels to electronics, are about to panic. They will scramble to secure whatever physical silver they can find at any price. So, what does this mean for the price? We're looking at a few potential scenarios. In the first, the market somehow stays calm, and we see a steady, orderly rise. I find this highly unlikely. The second, and most probable scenario, is a bifurcation of the market. The paper price on exchanges like the COMEX might say silver is $100 an ounce, but in the real world, the price for actual physical metal could be $200 or even higher. The price becomes a fantasy because you simply won't be able to get your hands on it. The bottom line is this: silver is going much, much higher. The only question is whether it's 30% higher or 150% higher. This creates one of the most asymmetric risk-reward opportunities I have ever seen. The downside is incredibly limited because the pre-existing supply deficit already guaranteed higher prices. But the upside? It's absolutely explosive now that China has pulled nearly 40 million ounces off the table. If you don't own physical silver before February 1st, you're making a huge gamble that you'll be able to buy it after the news truly hits the mainstream. Good luck with that. So, what should you do in the next 48 hours? How do you position yourself for this historic event? First, buy physical silver now. I don't mean tomorrow or after you've done more research. I mean right now. Every hour you wait is an hour closer to the ban taking effect. It's an hour where someone else is buying the silver you could have owned. Call your local coin shop and check their inventory. Buy whatever they have left. If they're sold out, go to online dealers. If they have a 2-week delivery time, that's fine. Accept it. At least you'll have metal on the way. Yes, you will pay a premium. And yes, the spot price might see a temporary dip before it rips higher. None of that matters compared to the risk of being completely unable to buy at any price when the real shortage hits. Second, if you absolutely must use paper assets, focus on the silver miners. I always recommend physical over paper because paper contracts can and do default. But if you're looking for leveraged exposure, mining stocks offer amplified upside. When the price of silver rises 50%, the miners can often jump 100% or more. Their operating costs are relatively fixed, so their profits explode as silver's price climbs. Look at companies like First Majestic, Pan American Silver, or Hecla Mining. If you have a higher risk tolerance, the junior explorers offer even more leverage, but also more volatility. These stocks have been beaten down for years by the suppressed silver price. When that suppression finally breaks, they will fly. Third, prepare for extreme volatility. The big banks have colossal short positions on silver, and they are not going to go down without a fight. When silver rips higher, they face catastrophic losses. Expect every trick in the book. We'll see flash crashes, mysterious technical glitches that halt trading, and sudden margin requirement hikes designed to force people out of their positions. You'll also see a flood of propaganda telling you the China ban is insignificant and that silver is overbought. You must ignore all of it. This volatility is the proof that you are winning. They wouldn't be attacking the price if they weren't terrified. Finally, think long-term. This isn't a one-time event, it's a permanent structural shift in the market. While China could theoretically reverse the ban, their strategic thinking suggests this is here to stay for years, not months. This means the supply deficit will only get worse every single year the ban is in effect. Silver at $100 an ounce won't be the end, it will just be the beginning. Prices of $150, $200, even $300 are all on the table. Don't sell at the first sign of profit. Don't try to time the market. Own the asset and let the fundamentals do their job. For years, we've talked about the silver squeeze, the manipulation, and the day when physical reality would finally crush the paper fiction. That day is almost here. China has lit the fuse. The banks are trapped, the vaults are emptying, and industrial consumers are getting desperate. You, watching this right now, have a 48-hour head start that the mainstream financial media refuse to give you. Use it. Buy the metal. Hold the metal. Ignore the noise. Prepare for a repricing event that will make the 2011 run to $50 look like a gentle warm-up. This is FinSphere Global. The countdown to February 1st has begun. I'll see you on the other side. Remember to like, subscribe, and hit that notification bell. Share this video with everyone who needs to hear it before the clock runs out.